My name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. So today, let's start out with this is for entertainment purposes only. It is not financial advice. That is not what this channel is about. It's about making bad financial decisions and doing the mental gymnastics on how we get there. So today I was on Reddit and someone asked, okay, so on YouTube, I keep hearing about a three-fund portfolio that's more modern, but when I get onto Reddit, specifically the R ETF sub, I everyone is saying Bogglehead or nothing. Like that is the one true path, and you shouldn't do anything else. And they're very confused. And they asked, "Well, which one, in your opinion?" And it really, you have to understand why the people are recommending these things. And I replied, and then the thing with a lot of boggleheads are, yes, it has been around for a very, very long time. And yes, there have been a lot of studies on it. However, at some point, if something has been outperforming you for 10 plus years, you have to concede that maybe something that came out more recently is capable of giving you better returns than what was at the very beginning of when you were able to invest in the first place. So that's all. That was pretty much where I'm going with. So maybe we'll say Boggleheads is the bad financial decision. I will tell you why I think it's a bad idea. Um, are there cases when it is a good idea? And am I going to do it? So, why I did some back testing with testful.io, and I'm only sharing a very small portion of my screen, but I do like using this for back testing, and you can add portfolios at the same time, but I find that you get different results. So I just test things one thing at a time, and they have cool charts that you can look at um, just to understand when you're back testing what's going on. But the things that I cared about on here were if you had $10,000, what is your total return? What is the average increase, or I guess decrease, um, growth? And then what is the max drawdown and the volatility? So um, if you decide to just do VU and chill, 100% VU, from and the October 20th, 2011, that date is when SCHD, that's its inception date. So from the time the SCHD was a thing to today, if you had done Professor G's portfolio, you would have more money than the VU. But if you just from that inception date, you would have, you know, almost $60,000 with just VU. But you can see that the max drawdown is not great. And the volatility is also really high. But if you, this very latest market correction, I did from July 2020 or 29, 2024 to today, and it's not great. It's not last, but the volatility is very high. It's at 25.7%. The max drawdown is at 6.07%, and you don't, it's like second to last on the least amount of money you would have. and have the longest for recovery. But the good news is it is the stock market, pretty much, is a representation of it. And so generally, if we give it a month or two, it will be right back up there and performing pretty well, and it'll recover. So, and then the last date that I have on here is December 11th, 2009, and that is when SCHG was a thing. That was its inception date. And so for this one, SCHD doesn't exist, so I put BND back in. And I didn't pick a winner. The winner is obviously just VU. If you have the stomach for the volatility, you have way more money with VU than with any of these three fund portfolios. But here's the thing. The reason why people were saying 60-40 with bonds is because it does decrease the volatility in the max drawdown. And when you can control the drawdown, it takes less time to recover because it's not like when you lose 10%, you just have to gain 10% to get back to good. You have to do like 11 or 12% to get back to 10%. So it's just that it takes so much longer to recover once you've lost money that it is imperative to limit your downside potential. And that is how you win at the stock market, is to just the balance between taking advantage of growth opportunities and volatility while also protecting your assets so that you don't lose everything, so that you don't have to wait in the market for years and years and years for it to recover, and then by the time you recover, the next crash happens. So what we're trying to do is avoid that. So that's why with the 60-40 split of VU and bonds, you have the lowest volatility, and in some very specific cases, in the very short term, you might wind up on top with the most amount of money. However, with the Bogglehead, and I actually went to bogglehead.org just to make sure that I was staying true to what they wanted, or what Bogglehead stuff. And they're basically saying, like, as long as you stick with the spirit of the Bogglehead theory, it doesn't matter which particular funds you use. Like, is it a mutual fund? Is it an ETF? As long as it's a broad market, it is an international fund, and it is a bond, you are following Bogglehead. And I just want to make sure that I was getting the allocations correct. I did just do a 34, 33, 33, an equal balance for these. But so the really where the battle is VU, VXUS, BND better or worse than VU, SCHG, and SCHD? And when I put in, hey, this is the max time that all three of these funds have been available and in existence, I could have more money than if I was just in VU. And my max drawdown is not as much as if I had VU, and my volatility is slightly less than if I was just in VU. And the theory, the reason why they're calling this like the modern day Bogglehead three fund portfolio is two things. International fund, that is what they meant for growth. Also, by the way, don't trust me on this. You can find better videos that explain this much better than me. But this is my understanding of what I heard. So, for international, the logic behind that was because it's a less developed market, it's more volatile and there is more room for growth. And so, in the modern portfolio, we say, okay, but most modern companies are in the international market, even if they're US based. And just because they're international doesn't make them more risky. So, why not just, if the intent of that piece of the pie is for growth, let's use a fund that is specifically looking for growth for stocks that have had that follow the SCHG's high growth indicator fund. And the same thing kind of with bond happened. The theory with bonds is it's an uncorrelated asset. And therefore, when the market, S&P 500, tanks, it's supposed to act as the inverse. So when things are going good, your BND is going to be like -1, -2%, whatever. And, your view's going up and up and up, and your bonds are going down, down, down a little bit. And the hope was like, oh no, 30% drawdown. And then bond is like, okay, cool, I'm going up 10% or 12% or whatever. And it would balance out, and you can just take the bond out and put it back into it, like rebalance. But it's not perfect like that. So sometimes it does move more with the stock market than the theory of using bonds, like what you would hope for with that theory. But SCHD is still equities, which means it does move up and down in like the market does. However, because their value and they give dividends and they're more stable companies, it doesn't move as much as VU or SCHG, which means that over the long time, well, SCHD also gives really, really high dividends. I believe that the dividends are higher than BND. And since a lot of people use these three fund portfolios to retire, it's important that when you're starting, like if you have 15 years to retirement and you start investing in SCHD now, every year for the last decade, they've increased their dividends and there's no NAV erosion. So the price of SCHD keeps growing, which means if you start buying now, your personal cost basis will be much less than the person buying 15 years from now. So even if the amount of dividends, like it stays at 3%, even if it stays steady like that, with the price appreciating for the ETF, it means that your personal cost basis, you're getting, 4, 5, 6% on SCHD in 15 years, as opposed to the person that just does growth bonds or just does VU and then buys an SCHD later. So, and with the 4% rule, you really want to have stable, really good equities or bonds or whatever, something steady to give you an income. And when it does that, you can live off of it and you don't have to actually be pressured to sell your growth and your broad market in order to sustain yourself because you have SCHD. And it doesn't mean that you won't ever sell off any of your VU or SCHD to get more income, But if you start earlier and you get it at a cheaper price, you'll have more shares and it'll be better later. So you can cherry pick the time frames that you want to use, but it's been my impression that what you're looking for with these things. Also, you can backtest things before their inception date, but I don't pay for products like that. And it's a lot of finagling and like, well, this is the prospectus of it, so it would have been this, and it's highly theoretical. But to me, SCHD has been around since 2011. That is 13 years, one recession, and like 4 or 5 major corrections. So it's probably enough time to get a feel for how this fund works and how this portfolio would work in different situations. Like, you can focus in on specific time periods that you're concerned about. Like, if it's a bad market, how will I fare in this? And you can zoom out and like, I understand that for retirement, everybody has a different level of risk that they are willing to take on. So, you would have the most money if you had VU, but if if you're 15 years away from retirement and on 13 there's a major recession and you've lost all your money, you're gonna have to work for 5 more years because it'll take that long for it to recover. So you have to hedge it or diversify and lower your volatility. So then you get bonds, and then it's a slippery slope. And it's about, my impression has been, decrease your volatility. Try to decrease the max drawdown. And then look and see, as like a secondary, has this fund been around for years? You don't normally, and I know that I've not followed these rules, but you have to know the rules before you can break them. But ETF funds come and they go. So you don't want your ETF that you put your money in to shut down, because technically it'll close and you'll get your money back, but by the time they close, your shares are worthless anyway, so you don't get any money back, which at 13 years being around, I'm pretty sure that SCHD and SCHG are gonna be around. But yeah, time in the market is better than timing the market. And I guess that is also true for funds, where like having a proven track record before you put your money into something is also very valuable. But it is good to do some back testing and understand why people are saying these things. And it's just, I think the argument of, well, it hasn't been around for 40 years or 50 years or 100 years. Like, the market has changed. Prior to the 2000s, like, the market's not behaving the same because technology is taking over everything. So I don't see the major upside of not evaluating newer funds, like things that are more than a decade old but less than 50 years old. and trying to see if it fits within your portfolio. So, anyway, um, what do you think? Are you a bogglehead? Or I have no patience for bonds. And I know that I've been looking at them as a hedge for like TLT and stuff. That's why I'm been so hesitant. Like I just don't like it. I would rather be in SCHD and earn those dividends and swallow the fact that when the market crashes, it's also going to crash in the market, but it'll crash less than the market. Like, um, and just keep getting the dividends than to mess with treasury bills or bonds. And it's just a preference. And I know I'm wrong, which is why the last two videos have been like, okay, well, now it's time to diversify. We've had this correction, it's been fun. But, limiting your drawdown is actually still important. So, that's my opinion is it's down to preference. And there's no right or wrong. It's just whatever your individual risk tolerance is, and what you have to have the conviction, because bad times will happen, and you have to look it in the eye and say, I did my research, and you will recover, and I will have my money in a few years. So, anyways, I will see you next time. Bye.